Hi, everyone. Welcome to the show. Thanks for tuning in to Options Education Month here at TD Direct Investing. I'm your host, Brian Rogers, and I have some good news for investors and traders out there who might be feeling pessimistic during the market downturn we're experiencing in 2023. Yes, it can be tough looking at your portfolio and seeing more of the color red than you might like, but there are potential opportunities in almost any market, bear markets included. It's just a matter of taking the right approach. Well, options trading may be one avenue to consider. There are ways options can help traders scoop up shares at a relative discount, potentially earn income from stocks they hold, and help limit the downside of their positions. So, we're going to explore some approaches to help us navigate these turbulent times. Let's bring in Jessica Inskip, Director of Education and Product at OptionsPlay. Jessica, thanks for being here with us.
Happy to be here. Looking forward to the engaging conversation.
Can you tell us a little bit about the work you do at OptionsPlay?
Sure. So, my job as the Director of Education and Product is really to make sure that we simplify complex subjects in the most easy to understand manner and integrate that fully into product. So, something that's difficult to do when you have the complexities of options, you want to make sure that you can fully understand it and how to apply it, both from just a conceptual manner all the way down to actual application within the product and the software that we use, and also across brokerage firms as well.
All right. Well, you have, I know, extensive experience with options, and you've had done several interviews similar to this to talk about options. Where do you find options traders tend to stumble when trading during bear markets?
Absolutely. It tends to be more of a process, first and foremost. Options have complexities involved with them, different from stocks because they have an expiration date and their pricing is derived from more than just the underlying security. So when you add that layer of complexity with just the components that comprise options and then layer on a bear market where that can be kind of taunting for the individual investor, having a process is extremely important no matter what type of market that you're trading options on. But you have to exercise an additional amount of care when in a bear market. So it's process and having a disciplined strategy and taking that emotion out of investing.
Yeah, there's always that emotion aspect, and I know when we're on the bear market, it seems like we're all, a little bit more tense during that downside versus when everything's doing well and going up. So that's a good point. All right. Well, okay, Jessica, I'm excited to explore some of the ways you trade options during bear markets. But before we do, a quick note to our audience that if you want to learn more about the basics of options trading, make sure to check out our video series using options for beginners. It's available in the Learning Center on Webbroker and on TD's YouTube page. So first off, Jessica, let's begin with a little bit of context first. Why might an investor want to trade options in a bearish market when uncertainty and fear may be high?
Yeah, that's the beauty of options. Options can be profitable in a bullish market, a bearish market, or even a neutral market, as long as you understand how to structure your options accordingly to that sentiment. So we understand options first and foremost. Then we align to our broader market sentiment and then drill down to individual securities or even sectors. But you'd want to trade options in a bear market because they can be profitable when an underlying security or even a broader market, depending on what you're trading, moves down. So that's first and foremost why we would want to do that.
Yeah, no, that's a good point because I know I've done this a lot of times psychologically again, like going back to that. I've thought, okay, well, now we're in a down market. I'm just going to step aside and I'm not going to do anything. I'm just going to wait. You have those positions you want to hold, and maybe you're a little bit more uncomfortable with that downside. But there are a lot of opportunities there on the bearish side. Would you agree with that?
There absolutely are. When we are thinking about the market, when it's bearish and it goes into the bearish cycle and things get defensive, there are plenty of ways to profit because different sectors move depending on where we are in the cycle. So, for example, traditionally, when we go into a bear market, you see flight into things like gold or perhaps even healthcare or utilities. Traditionally, generally speaking, those defensive sectors. But it's how to spot those, utilize those opportunities, and layer on options that can certainly help with that. And then additionally, there's traditional investors, just stock investors, do dollar cost averaging is what we call it. And there's a way to utilize options for the long term to capitalize on high implied volatility. So that pricing component we were talking about earlier. So the definition of implied volatility is the market's forecast of a likely movement in the underlying security. And it's something that actually is derived from options within the calculation. But it means that high implied volatility means that there's a higher anticipated movement in either direction. Implied volatility is higher with uncertainty. And where is the highest uncertainty? During a bear market. So there's lots of ways to layer on in that aspect.
And so we've established that higher volatility and uncertainty during bear markets can change the value of an option quickly. So it's important to have a trading plan before diving in. What goes into a well-defined trading plan in your view?
You have to understand your personal risk allocation on your overall portfolio. Perhaps you take 2% of your overall cash that you're willing to invest into one trade, or even 5% if you feel a little riskier. That's a personal decision that you make. However, you notice that those are two really lower numbers because we don't want to use all of our funds in one trade because you can lose very, very quickly. So that's step one. And then, of course, it's what we were saying before is layering on that process. Once I understand how much I'm willing to allocate, then I have a process defined on my entry point and my exit point, and I stay disciplined to those. So as soon as I create my trade, and then if it doesn't go the way that I intended, which certainly can happen, then we exit and we have a strategy on the loss side. And that's also true on the gain side. When we reach our max gain potential, or we set thresholds at perhaps 75% of max gain, you should exit at that point. It's having a disciplined approach, inclusive of risk allocation, is extremely important.
It reminds me when you said, not doing too large of a trade, Jessica, it reminds me of Tony Zhang would always have his comment on you want to have enough powder in the keg to live to fight another day. Have you ever heard that one before?
I have not, which is odd because I work with Tony every single day. So
I picked
that's
it
a
up on
good
one of
one.
our webinars a while ago. I thought it really stuck for me. But if those that haven't heard that, yeah, you want to be able to, make sure you're not using too much of your capital all at once so you can live to fight another day. What about, do you have any guidelines or anything you would offer for the viewers on, whether an option could be too expensive? We often get questions on, one, choosing a strike price. I don't know, maybe if you have some information on that you can shed some light on.
Yeah, absolutely. So we got to remember what makes up an options premium. The options premium is comprised of three major items. So first and foremost is the underlying security. Where is that relative to the strike price? The second is time until expiration. And then the third is implied volatility. So implied volatility, we've talked about a lot. If there is high implied volatility, not only for the market, but for the underlying security or those contracts, that means that the price is inflated, which means it's an opportunity to sell and create an open position on the sell side, or we sometimes refer to as short. Now, if implied volatility is lower, then that perhaps is an opportunity to buy and take a directional view. And directional means bullish or bearish. And then time is extremely important. That is a negative factor when we're buying options because time is always moving against us. So we have to make sure that we create an optimal environment for that, which is how we choose our expiration date. And then, of course, the inverse is true. If you're selling an option, then time works for you because it negates the value of the option. And we want to buy it back at a lower price. So how does that help us choose strike prices and expiration dates? We use delta to tell us our probability of being in the money at expiration. So delta, by definition, tells us how much the options premium will move if the underlying security moves up or down by $1. So an option that's at the money has a 0.5 delta. At the money means that the strike price, the agreed upon price, is the same as the market price. So if I have the right to buy at 100 and the market's at 100, that's an at the money option. That has a 0.5 delta, which is a general best practice when buying. You want somewhere relatively close to that. But if we're selling an option and we are wanting the option to expire worthless, then you want a lower delta. And a lower delta just means farther away from the money. Generally, best practices are a 0.15 to a 0.2 delta. But again, delta just tells you distance from strike price. And then time is really, really important as well. When we are selling an option, we're selling time. And when we're buying an option, we're buying time. And there's something called theta decay. So theta It decays on a daily basis. That's what theta tells us. As each day goes by, how much will that option lose in value? Meaning, as that time decays every single day, it's not linear. Something happens where the value of the option just immediately falls off of a cliff. And that happens about 14, 21 days until expiration, which means if I'm buying an option, I need to give myself some time for my directional view to be correct. So some of our best practices, in my opinion, is about 60 days until expiration, because that allows you enough time to have your directional view, but also sell to close some of that time that you purchased, because holding an option till expiration means time value is completely gone. And then if you're on the sell side, so you're selling options, if it's a covered call or a cash covered put or even a credit spread, generally speaking, we recommend about 45 days until expiration, because you want to make sure that you do capitalize on that theta decay or that time decay. That's going to really work in your favor. So it's having that process, knowing the positive and negative factors that affect each individual option that you are trading.
All right. Well, I know you said a little bit earlier on, you mentioned something about the level of risk you're taking. Is there something you're looking for when you approach a certain options trade?
When we're buying, we do a 3-to-1 risk to reward ratio, meaning whatever I spend, I want to make sure that I can make at least 3 times. And that's when I'm buying options, which also means a directional view. I capitalize from a sharp directional movement in either direction. And when I'm selling options, we look for the inverse, meaning I'm going to be able to lose about 3 times as much as I'm making. But so I want to capitalize or capture about 30% of the width of a credit spread, or that premium that I'm receiving. So that's on the sell side. And the reason for the differences there is your probabilities are higher on the sell side, generally because we can capitalize on the underlying security just being 1 penny in our favor. Meaning if we're selling a covered call, the call represents their right to buy at a certain strike price. So as long as the underlying security is just 1 penny in my favor, I'm still going to keep my premium and have my max gain potential. So that's how probabilities are skewed a little more in your favor on the sell side.
Thank you for digging into some of those guidelines and rules of thumb, Jessica. Just a quick note to our audience. If you're interested in hearing another option trader's perspective on managing an options portfolio, watch our webinar, Learn How I Minimize Risk as an Options Trader. So this is a pre-recorded, an archived event that you can watch. It's in the Learning Center and on the YouTube page. Let's go into some options trades to consider during a bear market. Along the way, we'll demonstrate how to execute each of them in our advanced dashboard platform. The first is selling a cash secured put. So I know those we mentioned that there's those 3 strategies we're going to look at today. So how does this work and why do you feel it can be a good fit for bear markets?
So just like that stock investor would utilize dollar cost averaging, what we do is use the obligations that are inherent of options. So remember that a put contains the right to sell an underlying security at a predefined price and for a premium. If I'm on the sell side of that put, that means I'm obligated to fulfill the terms of that contract, which means I have to, or I'm obligated to buy the shares at the strike price at any time through the expiration period. In exchange for that obligation, I'm of course receiving a premium. Now, which means if I'm receiving a premium and I'm on the sell side of options, the optimal environment for me is higher implied volatility, which of course equates to higher uncertainty, which is heightened during a bear market. And then of course we want to drill that down to an individual security. Now, the goal of this is when I sell a cash covered put, which means that the amount that it costs me to buy those shares, I'm holding aside because I intend to actually buy the security. But what happens is I can keep my maximum premium if the underlying security is above my strike price. So if the strike price is 100 and the underlying security is at 101 penny, then that means that my obligation isn't really going to kick in on expiration, because selling at the market price at 101 penny or anything higher is absolutely more advantageous than the terms that the contract contains. However, if it does go down, even I get to offset that purchase price by the premium that I received. So back in that example, if I have the strike price at 100 and maybe I received $5 worth of premium, then that means my risk at that time of the purchase is $95. And if you were to compare that to buying the stock at the same time at the market, it has the same substantial risk potential as buying the underlying security at the same time, but it represents a discount of $5 due to the premium that I received.
Yeah, and oftentimes people say on that strategy, "Hey, I was thinking of buying the stock anyway," right?
Yeah, absolutely. And that's the intent is you normally if you're selling a cash covered put, we'd say that's a bullish strategy individually, but what we do is we take the obligations that you tend to not want to happen when you're selling options on an individual basis, which is obligated to buy or in the case of the put, are obligated to sell in the case of the call, where you're saying, actually, I want to buy the stock anyways. This is a long-term view. And if it does move adversely because of a bear market, I'm okay buying it. And I'm okay buying it at this point because I also received a premium, which reduced my risk allocation
All
overall.
right. One thing, I don't know if you're aware of this, Jessica, but I know we have it in that term, the cash secured put. In Canada, we don't usually typically use that term because in our brokerages, we don't have the ability to set aside the funds to make it secured. So just a note to our audience, so it would be considered an uncovered or a naked put. So you can use that synonymously, but you can always have the cash set aside on your own. All right, what we want to do is, can you walk us through how you like to execute this trade and some of your best practices when using it?
So one, when we're selling the put, I want to make sure that implied volatility is high. But I also want to check that implied volatility is high. Why? Is it because of earnings coming up? That's something that could be a risk. And sometimes we want to avoid that because it can move drastically in either direction unless you really feel adamant about your long-term view. But it's just knowing all the factors that are occurring around your trade. Super, super, super important. So once I've determined why implied volatility is high, if it is earnings or not, and I'm going to sell that cash covered put, I need to choose my strike prices and my expiration. So, as far as your strike price, the agreed upon price, generally speaking, at OptionsPlay, our best practice is a 0.45 or a zero point 0.5 delta, which just means that it's really, really close to the money. And we choose that because we intend on buying the stock. And then as far as the expiration, we look about 45 days until expiration. That way we have just enough time because that's important because that inflates a premium. And as the time goes on, that premium is going to decay. And if it moves adversely or if it even moves in our favor, that gives us an opportunity to buy it, to close it at a lower price. And if implied volatility also collapses as well.
All right, let's take a moment to hop into Advanced Dashboard to show our viewers how to sell a put. So if I was considering buying Home Depot, I could buy it right now at $298.76, or I could even possibly collect some income and put that income towards the cost basis, or even just kind of put it in my account if the stock doesn't ever drop lower to that price. But if I did consider buying that stock anyway, I could say maybe I want to buy it at $280 or $285. I would click on the bid, and now this is going to give me, once I sell this contract, I'm going to have the obligation to buy Home Depot stock at 280 if it drops below that $280 price. So remember, you have no control when you're doing this strategy. You're going to have that obligation. If it does stay above that strike price, you're very, very unlikely to ever be assigned. And you would get to keep the premium, get to keep this $420, and then you could do it again the next month or the next month afterwards or next period, or however many days you're doing this as. Right now, we're doing roughly about 40 days, so you could do it every 40 days or you could do it every 30 days. The premiums and the expirations can vary, but that is an uncovered put scenario or strategy. So you just click on preview order and place the trade, and then you'd hope that if it stays above that 280, you get to keep that extra premium. Okay, let's move into our next trade, which is a type of credit spread known as a bull put spread. How does it work and what's the potential benefit to considering it during a bear market?
If we do a bull put spread, all that means is I'm reducing my risk potential. Meaning when I am selling the cash secured put or selling the put individually, it requires a lot of capital set aside, or you may have a lot of risk if you don't intend to buy the security. Meaning if you have to buy at that $100 per share, you need to have enough cash when you're assigned because you're obligated. It's going to happen to buy 100 shares at $100 per share or whatever your strike price is. When we do a bull put spread, That just means that we buy an option at a lower strike price. So we take our substantial risk potential, which is that obligation to buy, and give ourselves a predefined sell price because the underlying security can theoretically go to zero. That's where that substantial risk potential comes from. If we have a predefined sell price at a lower price, same amount of contracts, same expiration, then that reduces the risk potential. And we call that a bull put spread. The short put is still driving the strategy, meaning the same best practices apply. We intend to have that option expire worthless, which means we're capitalizing and keeping that premium. A bull put spread is capturing premium. The addition of the long leg is just purely for offsetting risk. In case the underlying security does move down adversely, we want to have a predefined sell point, which reduces your premium, but it also reduces your risk. It's always a trade off.
Yeah, there's always that trade-off. And I like how you said it drives the strategy too, that one, the short leg. I think I learned it initially. It was the dominant. You have a dominant leg and a weaker leg. I like the driving better. That's the strategy you're focusing on.
I like dominant too. There's so many analogies that I tend to use with the strategy driver, especially when we go into assignment. When you are the short seller, you're the passenger because assignment is driven by a long leg or the person who owns the security because you're obligated. And as a passenger, you can look at your surroundings and understand if the driver is going to stop or even turn left or right if they're indicating. So many analogies you can do with that one.
Well, can you take us through how you like to execute a bull put spread?
Now that we're on the bull put spread, you may not intend to be assigned because you've offset your substantial risk potential by having a predefined sell point, which is just a long put. So, as far as your entry point, we still have the best practices, which is about 0.45 to zero point 0.5 delta, which just means near the money. But if you are wanting some cushion or perhaps feel the security may go down slightly bit, you can choose a lower strike price. And that's where also we layer on technical analysis. So layer on your technical analysis and choosing your strike price based on where you feel the underlying security will be within your time frame. Same best practice applies for the short put as far as time frame is concerned, which is 45 days until expiration. That way we can still have that time value decay because we intend on closing this option when that theta decay kicks in, also known as time value decay, before expiration. Holding an option until expiration just equals risk, especially if we have something that is a strategy driver on the short side. That obligation can kick in at any time. As soon as the option is only worth its executable value, you are more likely to be assigned. So we want to make sure that we stay away from that risk.
Can you elaborate for anyone that's might be new to this strategy too, Jessica, since you're very familiar with it? I know I've had some people talk about this and they say, well, I'm a little bit scared. What happens if it ends up, a little bit below the short strike and not quite, I'm not being covered on my lower strike or the lower put. What happens in that case?
When that happens, you do not have to hold it until expiration. You can actually just close the option. It might be at a slight profit, may even be at break even. But what's important here is you have to have a strategy, and that strategy is inclusive of an exit strategy. And when the security moves adversely, which can happen and absolutely will if you trade quite often, you just have to exit, cut your losses, and move on to the next trade.
Okay, let's dive back into advanced dashboard to find out how to trade a bull put spread. So in order to enter that order, you click on multi-leg order. We would go to the same location down here at the bottom. We can go to the 290. We're going to click the bid. See how that's populating here at the top. It's going to be putting in a second leg just below that. I could select, say, a 285 or a 280. On the ask side, I'm going to click the 565. We'll do a $5 spread. So now you can see what happens is it's telling me it's a bull put spread up at the top. So it tells you what it is, shows you your maximum profit in this section here where you can see it's 120, which is what we're collecting. Shows me the maximum loss, which is $380. Remember, the maximum loss is if it goes below both of your strike prices, you're going to get assigned on the short option at 290, but then you can exercise the long put at 285. So it's usually a $500 loss minus what you collected as a premium of the $1.20. So that's just another example of using a bull put spread, how you would do that on the multi-leg tab in Advanced Dashboard. And any strategy you create here, and it's going to tell you what it is, and you're going to see your max gain, loss, and break even, and so on. Well, the last trade we'll cover is called the wheel. So it seems like we're getting into like a automotive topic here. So we're going to look at it because it seeks to generate income for a trader. How does it work, and why might it make sense during a bear market?
We talked extensively about selling puts and utilizing the obligation that's with a put. So the obligation to buy, and that happens when the put starts having value, which means the underlying security moves below the strike price. Now, the wheel strategy just takes that a step further, meaning I'm bullish long term on an underlying security, let's call it ABC. I sell my cash cover put on ABC at 100 strike and I get $5 worth of premium. As that option expires, ABC still remains above 100. So I do that again, get another $5 of premium, and do that again until I'm forced to buy the stock. And of course, can adjust my strikes and expiration every single time. You don't want the same one, but for that example, it's just for simplicity's sake. But I collected a lot of premium just with the intent of buying the stock. And the purpose of that is that reduces the amount of capital that I spent. Now, the second part of the wheel strategy is once you're assigned, you sell a covered call. And a covered call means that I have the shares as my collateral, because with a covered call or a short call, I'm obligated to sell those shares at a predefined strike price, which is the agreed upon price, at any time through the expiration period in exchange for a premium. So the key there is I actually want to adjust my deltas because I want to account for a capital appreciation. Because once I own the stock, now I have a completely different strategy. I'm still bullish, but when you buy a stock, what do you want it to do? Go up in value as much as possible, which means I have to be strategic with my strike price selection. And we generally are looking for a 0.15 or a 0.2 delta, which is that 85% chance of expiring worthless. In that case, 15% of being in the money at expiration. So what that means is as the underlying security moves up in value, I'm going to participate in capital appreciation, which is just the difference of where I bought those shares and the strike price. And I'm going to receive a premium, reducing the amount of capital that I spent. And I'll do that consistently, just like I did on the cash covered put side, or when I sold those puts and I bought. Now we're just switching over to the sell side, and I'm going to do that collecting a premium or this income stream until that obligation kicks in. And as long as I'm still bullish on the security, as soon as I sold that ABC stock, I'll just do it again. And we call that a wheel because it's just continuously moving, continuously collecting premium until I buy the stock. I choose strike prices that will allow me to participate in capital appreciation. So just go up in value to that selected stopping point, then keep receiving income and doing that consistently over and over and over again, as long as, again, my sentiment remains bullish on that security.
Well, that's a great explanation, and I like how the wheel is a good name for this strategy, like you said, because it's going around and round and round, and eventually that's what you're hoping happens if you're getting assigned, and then on the put, and then you might get assigned on the call. So going back to a little bit more to the wheel, so what are some key considerations when trading that strategy or the wheel strategy?
Yeah, so the first question that always comes up is what should I do if the stock moves adversely? And this always happens when we're on the short put side. And my answer always is, well, this is a bullish strategy, meaning you are intending to purchase a stock that you want to hold for the long term, that you believe is bullish, which goes back to that process. If all of a sudden something comes out where that sentiment changes, then you need to move on and no longer trade that security, because sentiment's extremely important. That's first and foremost. And then the same best practices as far as choosing strike prices and expirations apply for the cash covered put and the covered call. So we're just looking for the 45 days until expiration if we're selling. And then on the put side, we look for a 0.5 to a 0.45 delta because we intend to be assigned. So we want something closer to the options price. Remember, 0.5 means at the money, which just means the same price and strike price as the market. And then on the covered call side, that's where things vary, is we want to now account for capital appreciation. So that's extremely important to be cognizant of. Sometimes investors will prioritize premium over capital appreciation, which it's almost, you got to compare and contrast. And that's something that the OptionsPlay tool does really, really well, meaning that you're going to have a higher premium if your underlying security is closer to the strike price. And that makes a lot of sense because it's more likely to have value if it's closer to the strike price. But that means that you're giving up some capital appreciation. So that's something to know. And that's where technical analysis really helps as well, because technical analysis can just tell us starting and stopping points. So you can choose a strike price on your sell side based on a stopping point and taking into account capital appreciation that you can make in addition to premium. That's the important components to understand.
All right, so definitely some great things to consider there. Thank you so much, Jessica. We're going to jump into Advanced Dashboard one last time to show our viewers how to get the wheel rolling. If I did get assigned, if the stock did drop slightly below 280 and I got assigned, I got to keep that. I did end up getting to keep that premium, that $420. So now I could jump over on the left to the call side. Say if we had the stock jump back up a little bit after a little while up to 290, for example, we can now look at like a 300 or a 305 or 310, whatever you prefer. Let's say if we look at a 310, we're looking to sell a covered call, so which is now where we're selling the obligation to sell the stock at a certain strike price. So we would put that a little bit higher than the current market price at say 310. We're going to get a little bit more profit on the stock we owned, and we currently own, and we're also going to collect some more premium. If we did it at say 515, I would click on the bid. It's going to open up the order ticket. It's saying selling to open covered as an example. So then it's just if you have the stock, it's going to be covered. If you don't, it's uncovered. And it's going to show as the strike price you selected. There's the premium you're receiving. And then if it doesn't go above the $310, you get to keep that premium. But if it does go slightly above, you're going to cap your profit a little bit, but you're also going to be selling the stock at $310. And then you can jump back to the put side and you can do it over and over again. That's why it's called the wheel. All right, we're going to have to leave it there, though. Thanks for sharing your perspective on trading options during bear markets. I'm sure you've given our audience a lot to think about as they plan their own approach. Any final thoughts from you that you'd like to share with our viewers?
Yeah, I think it starts with education. I think that's the most important thing. So I definitely commend anyone attending today's session and making an investment in your education. I think that's the best thing that you can do, especially with options, because you layer on a level of complexity because options have expiration dates, which means they're going to cease to exist at some point. So just understanding how to create optimal environments around options and the mechanics of options is the first step to being a successful options trader.
All excellent. Well, thanks again so much, Jessica, for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.